Hi guys, and welcome to the blueprint video. In this video, we are just going to be running through the blueprint that is shared in the Discord channel. We're just going to follow a step-by-step guide. Today, we're going to be using EA. So if we switch over to the charts, let's just have a look what we've got. Switched over to the right one. Okay, so we're going to be using EA. So first of all, what we want to do is open up on the monthly chart. So we do this by selecting the month on here, for those that don't know, and we select the month. First things first, we're going to want to start working out our higher time frame structure. So this is done by marking our low here. Our high. And then we'll have a lower high in here. Sorry, a higher low. This will be a higher low. This will be a higher high. Switch up to the bottom. And then, as you can see, we broke below this higher low. So now we've got lower low. And we've didn't go above this higher high. So we have a lower high. Switch out to the top like that. So we've got our low, our high, a higher low, higher high, lower low, lower high. So next, we want to start marking out our structure breaks. So this is what we label boss. This is break of structure. And as you can see, this was our last higher low here. And so we broke structure to the downside because we broke past this and we made a lower low. So this is our structural break. So this is what we want to mark out. Once we've got this marked out, we can move on to find out where did that push come from that broke structure. Well, that push come from this area here, basically. And this here is what we call our origin. This is the origin of the push that broke the structure to the downside. So here, what we would see is the banks and hedge funds, we would have pushed price up as hard as they could, and then all of a sudden they would have sold off. So what we want to do is we want to look back when we're going to come back into this area and what is available in this area, because where the banks have pushed hard to buy before they've sold, they've still got buy positions that they're now in a minus. They need to come back and mitigate all them positions and close all them positions off so they can carry on with their sales. So what we then do is we have a look in this area. We see exactly what's going on. So let's have a closer look. We can stretch out our fib. So this is where we use our fib here. We stretch it from the highest point down to the lowest point. And we can put our mark out here. And then we can mark that 89%. Hang on. 89%. We're also looking for the institutional number. So I would keep this at 2000. That looks like a lovely institutional number. Banks love whole numbers as well, because you've got to remember banks run with algorithms. So algorithms love whole numbers. So we can mark this up. This is our 89% and 2000 institutional whole number. We can then have a look at what sort of S&D zones. An S&D zone is just the supply and demand zone. It's normally the last up move before the down move. So as you can see here, this was our last up move before our down move. So we mark the bottom of the candle. This here we can then mark out as our monthly S&D. Okay. So now we've can look for liquidity wipes. So again, these are all whacked at, all stack up as confluences. Liquidity wipes, and what a liquidity wipe is generally is retail traders will be looking for areas like this where it's rejected, it's rejected, it's rejected. So they will be shorting, 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 shorting. Could even do the same here, shorting, 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 all levels of rejection. So this is all built up liquidity. This is where their sell positions are. And above here, we're going to have like stop losses. So what we want to do is we want to come take that liquidity before they sell off. So the banks, what they do is they push hard quicker than everyone can close their positions, takes out all their positions, takes out all their stop losses, pushes into here, wait till it's picked up all as much liquidity as it can, and then it sells off fast, back in the same direction as where everyone was selling. So once we know we've got our liquidity wipe, this is a general good place that we could then return to. Like I said earlier, because this is where the banks have pushed up, they want to close all these positions off before they carry on with their sells. So now we've got these levels, we've got some IPA, which is improper price action. We've got some of that here as well. And basically this is where the banks are selling off so fast that there's no buyers at the same time as their sells. And we can see this, say like this candle down below, you can see the wicks overlap each other. So this means that there was some buyers and some sells in amongst here, is where this candle is a clean candle. So we can see that this was improper price action. So what tends to happen is the market will need to rebalance the market and come back and fill this. I think that's all for that section. So we can move on to our next section, which is number 6. We can mark out any equal highs and equal lows, as well as any retail trend lines, etc., where price is looking to wipe out that liquidity. So if we zoom back out, we can see that we would have had a trend line here. Retails would have been looking to get in, obviously, on every touch of the trend line. We say like this. And then we would have had another one sort of like this somewhere. So obviously sitting above here is all the retailers' sales. What they would have looked to do as well is would have probably looked to the break of the trend line, and then they're taught on the retest. So what we'll have now is so what we'll have now is retailers selling on this trend line. They might have had a support and resistance line along here. They might even have an EMA, like a double or triple zone. So what we'll have here, and on this test here, is we would have had everyone's sells and everyone's stop losses, again, more liquidity. So again, if we mark across here, these would be our equal highs. And then all the liquidity would be sitting above this. So before, if we was actually back in, say, February 2000, we would be looking at this like this. They would be selling, retail. But we would be waiting. We'd be waiting for that liquidity wipe, because we know that we're going to come up here and we want to be testing this monthly S&D zone, our 89% fib, filling this price action. So we would be looking for longs here. But obviously, as we know, price actually, let's put this back into replay mode. Price played around that level before taking out all the things before coming up and making a new lower high, closing all these positions, and then as it closed them, it obviously rocketed back down. So now what can we look for? So now we know what we're looking for. We're looking for a new downtrend. So we've made our lower high. So now we're going to be looking for our new lower low. So now we're going to be, we know we're not going to break above this unless we're going to be starting a new trend. We know we're going to be pushing down to here to make a new lower low, or at least make an equal low before making up to another trend. But we reckon we should be coming down to make a new lower low. So now what do? We know we want to come down to here, so we have to have a look to see, well, how are we going to get down to there? We can't just drive straight down to it. We need enough fuel. So in order to get enough fuel, we jump down to the weekly time frame. When moving down to the weekly time frame, we start our process again. We've got our lower low. We've got our high. We've got our high. Then we make a higher low. Hello. High. Higher low. Like I say, it's good to have these written out to visualize it. It does help. Before we make another higher high that's up here. And we can even move that. Move that one up here. That is our lower high on the, isn't it? Now we've got a higher high on the daily. To see how we get a structure on the higher time frames, and then we get internal structure on the lower time frames inside the structure. So now we know that we've got our boss here. This here is our break of structure. If we are we going to break this structure here to the downside like this, and make a new lower low, and then we could look for it to come up and then back down to this lower low like this, or are we going to come into this area here, not make a new lower low, not break structure, and then just come up to make possibly a new higher high, or even a higher low. But what we want to see ideally is this break of structure. But at the minute, we know that we are looking for sells down into this level. So if we jump down to the daily. And all we do is just use the same steps again. We've got that was a break of structure. This is our lower low. This was our lower high. This was a lower high. This was our lower high. We break that, but we broke structure down here. So this down here is now our lower low. So what we want to see now is low high, low high. We've come into this area. So we've got liquidity sitting above here. These equal highs. So what we could look at is we broke the structure to the downside. Where was that push from? That push was from this level or maybe even this level, but we have got some equal highs here. So I would be looking for maybe a liquidity grab from above here. Anyway, we know now we've formed a lower low. So now we should be looking for a lower high around this level. We shouldn't be breaking above this lower high. Basically, this is our range that we work in now. We work in from this range to this range until we break out. And if we break out, then it's one of them things, then we can start looking for our trend change and go off in a different direction. But so now we've got this level, we can look at our levels. So what have we got here? We can pull out our fib from here to here. We can see that we've tested this one on the 89% already. We have left some liquidity there. So it will be interesting to see if we pop back up there. So let's mark out this level here. This was our last up move before our down move. So this is our daily S&D and our 89%. We can delete this. What else have we got in here? So we know now we're going to be looking to come back up into this area. But when we do come up into this area, we want to see that we might go for a liquidity grab. So we have to see how it reacts. So then we jump down a time frame, we do the same again. We know that this is our lower low. Then we've got a lower high. And we've got a higher high. Higher low. Higher high. And we've also got equal highs here where the liquidity would be sitting. So again, we mark out. Let's just change this to the bottom to make it clear. What did we do last time? We made a higher high, we made a higher low. We broke structure to the upside here. Where did that push come from? That push come from the origin, which is here. So what do we expect next? Pull out our fib. We can mark out our 89%, which is here. We've also got IPA here. And when we've got big down candles like this, we can look at 50% of the candle to be tested, which, as you can see, is bang on our 89%. So yeah, this here would be, so 4 hour and 89%. Say 4 hour, 50% of the S&D and 89% of fib. So now what we're going to look for is price to come back into this level. And this level here gives us high probability that we're going to then push and break this structure and keep pushing to the daily S&D where we can look for shorts. See how structure we've gone from the weekly and the monthly. Look, we're actually on a downtrend to then we're on an uptrend, to we're on a downtrend, to we're on an uptrend. It's all called internal structure. Obviously, the higher the time frame, the bigger the priority is. So if we're in an uptrend or a downtrend to here, but we're in an uptrend, we know we're not going to break down to here. So we know that this trend should stop here before it reverses. So now what we can do is, now we've got this level, we can actually jump down to the 1 hour. We can see that this here was the last down move before the up move. So we could just adjust that slightly, and it's around the 700 mark. That looks like a good institutional number, but we can see when that plays out. And then what I would do is just set an alert for this level, probably 50% of the IPA, to keep an eye on it, see how it reacts on the way down. So now what can we do to get down to this level? I mean, we could still jump up and still make a higher high before coming down and making the higher low, because we can still make higher highs before we make the higher low. So for me, I would probably wait for it to come down to this level now. This would be the most high probability trade. We've also got equal lows here. So yeah, I would see which way we went out now. I would expect it to come down to this level now before going up. You can go down further down time frames, but for me, this is the most high probability level. I trade so many different pairs that I would wait for these levels because they're much better on the higher time frame than they are on the lower time frame. And I think that's about it, guys. Obviously, when we come into this level, I'd probably wait and see how it reacted. But if you wanted to set, let's see, we would come into here, we would go just below that down candle there. So you would be looking at 35 pips and taking it all the way up to that daily. It's going to give you a 1 to 37. So I'd be happy with just setting a buy limit there for a 1 to 37. Obviously, if you wanted to reduce that pip size on the stop loss, you could, when we get our alert set here, we can jump down time frames to the 5 minute, the 1 minute, and then we could wait for our schematic to play out, which we'll run over in a different video. So that's all for me now, guys. Speak to you soon. Cheers. Bye.